I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, tech shares leading U.S. stocks to all-time highs on this last day of the quarter. We'll have the latest, plus Coursera charting its path to the public markets. I'll talk to the CEO on their big IPO day. Plus, IBM CEO Arvind Krishna on the future of work. He says the company may get rid of nearly half its office real estate, with 80% of his global workforce going hybrid. And Brad Garlinghouse, the CEO of Ripple, joins me, currently under SEC scrutiny, what he has to say about that, crypto exchanges, and the future of Ripple. All those conversations in a moment, but first, market and movers. A big day for technology. Bloomberg's Kriti Gupta and Ed Ludlow have the full picture. Kriti, take it away.
Well, a fabulous day for technology stocks today, Emily. Just check out the board behind me. You're seeing the S&P 500 in the green, lifted by those big tech stocks. But even the NASDAQ 100 had a good day today, even though you saw those yields rising as well. Flip up the boards and let me show you how it did on a year-to-date basis, because, of course, we know this quarter has ended. But the NASDAQ 100 not really going anywhere, kind of making a pretty sideways move. And this is really important because they actually lagged on a sector basis. But this really tells you where we're headed. Flip up the boards one more time. And let me show you some of the movers on a year-to-date basis, the top two and the worst two. The top two here being applied materials, so that chip demand coming back to the forefront. We know the semiconductors have been rallying. We've also seen Walgreens Boots Alliance, so those pharmacies coming back as more people get their vaccinations. To the downside, though, some of 2020's favorites, Peloton, underperforming. And, of course, you also have Pinduoduo, so some of those Chinese e-commerce names not doing so great either. So that's the macro picture. For the micro picture, let's go to Ed Ludlow.
Yeah, I'm going to kick it off with Microsoft. That was one of the biggest points movers on the NASDAQ 100 today. Contract with the U.S. Army, which we knew about, is worth $22 billion over a 10-year period. Reminder, when that contract was awarded in 2018, it was more like $400 million. So that has changed significantly. And I love it when a chart tells the story, because Microsoft was higher through much of Wednesday and then pop. There it goes. That's how investors feel about the value of that contract to Microsoft to manufacture those augmented reality headsets for the US Army. Flip up the boards, though, because there's a story we can't get away from, and that is Joe Biden's $2.25 trillion infrastructure spending plan. And a big focus of that is climate-linked stocks. Look at the Raymond James note out. Around $630 billion of the $2.25 trillion is all climate-related, and a big part of that's the EV story. No wonder, then, that we saw Tesla up 5%. Of course, you just said end of the quarter, year-to-date, Tesla is one of the laggards so far, but it's clawed back some of those losses in a single day. Some other movers in the EV space there. Flip up the boards, because a big part of that plan is 500,000 public charging stations throughout the US. So again, no wonder. Look at the performance on the day by some of the biggest names of publicly traded charging companies. ChargePoint up almost 19%. There is a broader energy story to this. Joe Biden wanting to double down on renewable sources of energy, but also energy storage. So if we flip up the board one more time, you can see that the love was felt throughout those publicly traded providers of renewable energy, alternative energy storage systems. One final area I want to look at, if we flip up the boards for a final time, is $100 billion committed to being spent on rural broadband, basically, giving people access to internet. This is something, Emily, you've discussed on the show a lot. In society, a lot of the disparity is caused by a lack of training, a lack of access to internet. And you can see, actually, what's interesting, a lot of the telecoms providers not that much higher. T-Mobile higher by 0.5%. There is a 5G angle to this as well, and T-Mobile's been a surprise leader in the 5G space. But all eyes on Joe Biden and how he's going to spend that big $2.25 trillion infrastructure plan. Emily.
All right, we're going to talk about that now. Bloomberg's Ed Ludlow, thanks so much. President Biden has outlined his, as Ed said, $2.25 trillion infrastructure plan for the United States, setting the stage for a drawn-out battle over his second big economic program after his pandemic relief package's relatively smooth sail through Congress. Let's get the latest from Bloomberg's Laura Davison, who's been following this. So, Laura, talk to us about the benefits that the tech industry in Silicon Valley might see as a result of this new package.
Yeah, but Biden has taken a really broad definite structure here. So there's a lot of investment into digital infrastructure. So looking at broadband upgrades for people around the country, a lot of money going towards research for tech and STEM fields, a lot of training and money as well to kind of address gender parity and racial inequalities in the tech fields, as well as, pots of money going for certain things like electric vehicles as well as semiconductors. So there's a lot of stuff to love there for technology companies. But on the other hand, they're also facing a lot of tax increases as well, potentially.
So talk to us then about the taxes and how would the minimum taxes on domestic and foreign profits impact the tech industry?
Yeah, so these are two things that will really, really hurt a lot of big tech companies specifically. Tech companies have been very, very successful at using kind of these offshore structures to be able to reduce their tax bills significantly and pay, well below the U.S. rate, or in some cases, no taxes at all on the profits they earn overseas. What Biden would do would put a 21% rate on all of those profits, so they would be paying significantly more. Plus, there's also a provision looking at income in the U.S., specifically for, what the difference between what they call tax and book income. So this is the difference between what they report on their financial statements and what they actually report to the IRS. And a lot of times companies, and we've seen this with Amazon, Netflix, Zoom, they've been profitable but have not actually had to pay any taxes because they've had so many tax breaks and deductions and credits available to them to use. Basically what Biden's saying is you wouldn't be able to do that anymore, and you would at least have to pay 15%. So all the tax strategies that tech companies had for years would likely be virtually gone if Biden were to get this plan through.
So how does the plan move forward from here? And do you expect more opposition to this than we saw for the stimulus package?
Yes, there will certainly be more opposition as this moves through Congress. There's not quite the sense of urgency as there was with the coronavirus relief bill. Plus, there's a lot in here and a lot of tax increases and a lot of things that are politically tricky going forward. This is likely going to move forward with just Democratic votes, but even still, the Democrats have very small margins. In the Senate, they have to give all 50 senators, and in the House, there's only four members, Democrats, that can vote against it without blocking the bill. So this will be a negotiation going forward. This is really an opening bid. We expect to see over the next couple months that there will be negotiations happening. Even some key Democrats have already said, hey, Joe Biden, this is great, but we're going to come up with our own plan. So there will be kind of, merging and deleting and revising as this moves forward to try to not only, get all the priorities that Democrats want, but make sure that they have the votes that they need to get this through.
All right, Bloomberg's Laura Davison, thanks so much for that update. Coming up, with vaccine rollouts ramping up globally and many companies starting to reopen their offices, IBM CEO Arvind Krishna is now working on how to bring 345,000 employees back to work around the world. I'll speak to him in a conversation about the future of work next. This is Bloomberg.
How do you create teams? How do you do creative work? Those are all the questions we have yet to answer.
IBM CEO Arvind Krishna took the top job on April 6, 2020, 3 weeks into a global lockdown. Keeping 345,000 employees in more than 175 countries both safe and productive was a massive undertaking. Now the CEO is faced with the huge task of bringing all of those employees back in some form or another. In an in-depth interview for Bloomberg's Future of Work Summit, I asked Krishna how many employees are back so far and how much remote work will continue to be part of IBM's future.
Maybe 80% of people are going to come back to work in a hybrid way. But let me explain hybrid, because hybrid doesn't mean that some are remote or some are in the office. By hybrid, I mean 80% will spend at least 3 days a week, maybe not all 8 to 10 hours, but at least some fraction of those 3 days in the office. Because of how do you create teams, how do you do creative work, how do you have the serendipitous actions, etc. Do I have all the perfect answers for are we going to leave it up to individuals? Is it going to be more orchestrated? Those are all the questions we have yet to answer, so I want to be clear on that. But I expect 80% will spend some time in the office or with clients or with each other somehow, somewhere. Could I see 10 to 20% being remote forever? It's possible. But then I'll tell you, I worry about the same as the words you mentioned. So when people are remote, I worry about what's their career trajectory going to be. If they want to become a people manager, or if they want to get increasing responsibilities, or if they want to build a culture with their teams, how are you going to do that remotely? So I think we can maybe figure it out, but we got to go work on it. On the other hand, if somebody's in certain roles, I could imagine in some form of deep customer service, it's probably fine to be home. But now if they want to do something else, now what do you do? So I think that the answer I have is maybe closer to your first half. They're going to come in, but that means the nature of the workplace is going to change. So the workplace may not be a set of cubicles or closed offices where people come in, go behind a door and get all their work done. That they might be doing partly at home. The workplace is going to be a place where you meet and you build your culture together. That means the physical nature of the workplace is going to change. And likely the amount of total real estate you have might also change.
So going into the pandemic, you had 70 million square feet of office space and more than 1,000 offices. Are you getting rid of some of that? Have you already?
I would imagine that we will get rid of tens of millions, Emily. Are we going to go towards zero? Absolutely not. Will we have over half of what we had? Most likely. But I think that as we consolidate, as we want to bring people together, there's an opportunity to, make the shift from, as I said, from cubicles to more meeting spaces. But also, if people are only going to be in there half the time, maybe 2/3 of the time, the total amount you need is going to change. And we are lucky, maybe. A lot of our office space is leased, not necessarily owned, albeit where I am sitting, I can tell you, is a building we do own, not lease. So it's a mixture, but I would imagine that there is going to be a substantial change, but it will take years. It's not going to happen overnight.
What are your biggest concerns about innovation, and can innovation keep up in a hybrid environment?
I'll give you a great example. So my research team, who works on some of the hardest problems around quantum computing, around physical semiconductors, around chemistry, they actually have been coming in through the pandemic because they saw that they could not get their work done remotely. And they were excited to come. They were following all the protocols on social distancing, on testing, on signing up on everything as you enter and leave the building, and being careful at home. By the way, that whole community has had, I think, maybe one incident in the last 12 months. So that's remarkable. I believe that the serendipity of being able to walk the halls, of having those conversations, we know that those are where some of the eureka moments come from. By the way, my R&D community is hankering, by and large, to be back together. Maybe not 40, 50 hours a week, but at least some. So I see that those communities are going to be back together sooner rather than later. And so sort of full credit to all the vaccine makers and the rollout. I think the rollout is more optimistic than our worst fears. Of course, we would all desire it to go even faster globally, but at least in some countries, I can see a pretty good take-up. And I'm hoping that by late summer, we're in a state where a lot more can be back together.
So where are you now? How many people are back? How many people are still remote? And I understand that there are plenty of people who never went home at all, the people testing the mainframes and the quantum computers.
Yeah, so 350,000 people globally, about 5% never went home. The people are, as you said, on the mainframe floor, the people in doing sort of the physical hard R&D, but that's maybe 8,000 people who continuously stayed. Today, we are at about 15% are in the office. It varies a lot by geography. So at that number, you can say somewhere between 40 to 50,000 come into work, some. But now I'll take two extremes. If we look at Australia, we look at China, a lot of people are coming back to work. We look in Singapore, maybe in the middle. I now come to Western Europe, almost nobody's in the office. I come to the US, maybe 10% are in the office, but it varies. Where I'm sitting is in a suburban location. You can easily get 20% of people into the building in a completely safe way. If I'm in New York City, our buildings there are at 1 or 2%. By the way, the 15% we're in is not mandated. We simply open the buildings right now and we say that those who feel safe can choose to come in. Somewhere later, maybe we'll get to should come in, but we're not yet making hard and fast rules.
IBM CEO Arvind Krishna there. You can catch the full interview at Bloomberg.com. And coming up, Coursera, a household name to millions of students, joins the public markets, trading well above its IPO price. We're going to speak to CEO Jeff Maggioncalda next about the future of education technology and when in-person classrooms resume. And as we head to break, a look at vaccine makers. Pfizer announcing its vaccine gives 100% protection in children ages 12 to 15. Great news. This as France announced another 4-week national lockdown to begin Saturday. New restrictions there and in Italy as cases of COVID-19 surge. We'll keep watching. This is Bloomberg. Online education provider Coursera made its trading debut on the New York Stock Exchange with shares trading more than 36% above its IPO price. The company has raised $519 million in this offering and now has a market value of $4.3 billion. Coursera CEO Jeff Maggioncalda joins us now to discuss the large boom amidst the pandemic and whether demand keeps up. So first of all, Jeff, just give us your reaction now that trading has closed for the day. You got a nice size pop there.
Yeah, I've been a CEO for almost 25 years, and the last company that I worked with for 18 years was Financial Engines. We went public in 2010. It was a different time. It was obviously a non-pandemic, more traditional roadshow. This has been a different experience. But in both cases, it is really just a step in a longer journey. The company here, Coursera, is 9 years old. We have so much work to do. Couldn't ask for a better day today, but still, there's so much more ahead of us.
So let's talk about what lies ahead. Obviously, online education has been booming through the pandemic. Of course, you thought that this was a revolution that was coming all along. But what happens post-pandemic to online education when kids are back in school and everyone is vaccinated?
I think it's useful to go back to some of the trends that existed prior to the pandemic. I mean, clearly when Andrew Ng and Daphne Koller founded the company, two Stanford computer scientists, there was no notion that a pandemic was coming, but there was a notion that in a changing world, greater access to online learning and high quality online learning would be increasingly important. COVID has basically just accelerated existing trends. It has forced almost every student to learn online. It has forced almost every teacher to teach online. It has forced all of us to work online. And so there will be a new normal. It won't be exactly like what we've experienced in 2020, but it will also not be like what the world was prior to the pandemic. And I think it's going to be more of a blend of in the office and remote work and on campus and online learning.
That said, you have more online options in addition to Coursera now, and many institution schools have now built this into the very way they deliver education. What about that competition? What will set Coursera apart in the future?
I think what has set us apart from the beginning is that what started at Stanford with two Stanford professors immediately became a community of universities. So University of Michigan and Yale and Duke and Princeton all joined this platform early on. It is a community of leading universities. And what we've seen about business models is platforms that bring together communities usually do a better job delivering value to consumers or learners than any single company can do it, even if you're a commercial dedicated company. We really believe in the value of this community of universities in reaching a global population. So it's very difficult for one company to create all the value and to create all the distribution. It is much easier for a community on a platform to have more global reach, broader selection, and often more affordable prices.
Now, you're still not profitable, and last year net losses widened. What's your plan to get to profitability and continue growth?
Well, we are really focused on growth, obviously. In the next 10 years, about 1.3 billion people will become working age around the world. And especially in rising economies like China and India, in Latin America, and then probably to follow will be Africa. rising middle classes generally need more education, and they're looking for things like bachelor's degrees. So there's a lot of opportunity and need ahead of us. These types of moves, like raising money and becoming a public company, we think will position us better to have the resources to grow. We'll be investing those resources. And as we think about the investments, you could look at it in terms of dollars, but you could also look at it in terms of profitability margins. We continue to get closer to profitability, but we're most focused on growth right now.
So where does most of the growth come from in the future? Is it academic institutions? Is it enterprise?
Yeah, I think that there's, on the supply side, there's who is creating the content and credentials and what kind of content and credentials will be most in demand. We have universities creating them. We have industry partners creating courses and degrees. We believe that college degrees will remain a very attractive way for people to learn and a credential to show an employer that you are employable. And it's not the traditional degree. We believe that degrees are becoming, when they go digital, more flexible, more affordable, more job relevant. So we are very bullish on college degrees. But in addition to that, professional certificates for people who don't have a college degree to get an entry-level digital job, we see a lot of demand in that field as well, especially for people switching careers. Yes, sorry. Sorry?
We just heard from the CEO of IBM earlier, who said he thinks 80% of his workforce will continue to be hybrid going forward. Do you have a number like that for students? Quickly, we have about a minute left.
Yeah, we don't have a number, but I think it's a useful statement. We believe at Coursera, our employees are not all going back to the office either. And in the same way that going back to work will never be the same as it was before the pandemic, the way we get educated won't either. We see a hybrid world where certain traditional students will go back to campus, but a lot of people are working, have families, and are international and cannot move to campus. There will be a much broader set of opportunity when degrees and learning in general goes online.
All right. Jeff Maggioncalda, CEO of Coursera. We'll keep watching you now that you're out there on the public markets. Thanks so much for joining us. Coming up, we are speaking with Ripple CEO Brad Garlinghouse about the current regulations surrounding crypto and what to expect from exchanges, prices, and, of course, Bitcoin. That is next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Deliveroo, the Amazon-backed food delivery startup that had a sour debut in London today, sunk 31% in its first few minutes of trading post-IPO. Let's get the story from Bloomberg's Ed Ludlow. Ed, what went wrong here?
Yeah, this is a story not about the investors that do back Deliveroo. It's about the investors that did not. A lot of investors stayed away because they were concerned about the ongoing issues with Deliveroo's couriers and how they were being treated. If you're a tech founder of a startup that's going public, this is the chart that you do not want to look at. Look at the precipitous decline at the beginning of the trading day in London, and it stayed that way for the rest of the day. There is a bigger story here too. If we flip up the boards, a lot of around Deliveroo was hopes for the future, post-Brexit London, attracting big tech companies to IPO on the London Stock Exchange. It hasn't really panned out that way. This is the gross proceeds generated through IPOs so far this year. London is negligible by comparison to what we've seen in the United States, 10 billion versus 146 billion. There was so much hope around Deliveroo, and it just didn't really come to fruition. If we flip up the boards a final time, there's the specific Deliveroo concerns that investors had, but there's also a question around timing. This is all of the global peers that were already publicly traded: Uber, Just Eat, Delivery Hero in Germany. None of them are doing very well. The story in the first 3 months of this year is not about stay-at-home stocks. We all did that at the beginning of COVID. We were all at home getting takeout. Now it's about the reopening of the economy as the vaccine ramps up. What are we going to be spending our money on outside of the home? And one reason that you might see that orange line, Uber, outperform the rest of the pack is that diversified business model it has. Rideshare is coming back as people get more confident about exploring outdoors. Those other companies, they just do food delivery. And that is not something that is set to suddenly take off again like it did exactly 1 year ago, Emily. And that's part of the problem for Deliveroo.
Interesting. Obviously, we'll continue to follow. Perhaps they just missed their window. Bloomberg's Ed Ludlow, thanks so much. All right, one area back in the spotlight, still in the spotlight. Crypto, Bitcoin back on a tear today, hovering just under $60,000 for the first time in weeks. But with popularity, of course, comes scrutiny as crypto begins to make it more mainstream with institutional investors. There are questions around where U.S. regulation stands. Back in December, we saw the SEC take action against Ripple Labs, alleging that sales of their XRP token fell under unregistered sales of a security. Ripple has argued the coin is not a security, but rather an asset. Ripple CEO Brad Garlinghouse has commented on regulation surrounding crypto in a tweet saying, "Our defense begins today. Innovation is on trial, and we stand shoulder to shoulder with our partners and the community to defend it. Together with appropriate regulatory oversight, we can modernize outdated laws that clearly aren't working to protect consumers and ensure orderly markets." Ripple CEO Brad Garlinghouse with me now. So Brad, just give us an update on the situation with the SEC. Where do things stand? Obviously, you intend to fight this vigorously.
Thanks for having me, Emily. Indeed, we do intend to fight it vigorously. From our point of view, what has happened here isn't really just a lawsuit against Ripple. It's really against the crypto industry at large. As you know, and as you and I have talked about on this show, that the U.S. has been a laggard in providing regulatory clarity so that investors know how to best invest and entrepreneurs can build companies and hire people. Ironically, a lot of countries around the world have had that regulatory clarity. Just here in the US, we've kind of lagged that. So the UK, Japan, Singapore, Switzerland, all have very clear regulatory frameworks. And actually, ironically, on the topic of the lawsuit the SEC has brought against Ripple, the only country on the planet that has viewed XRP as a security is the United States SEC in bringing that lawsuit.
So is there a chance of a settlement? And what happens if you lose?
So look, I'm hopeful that as a new administration comes into the SEC, there's an opportunity to revisit some of those conversations. As you may know and may recall, Jay Clayton, as the chair of the SEC, the day before he left office, he brought this lawsuit against Ripple and against me personally, against Chris Larson personally. And we don't think that made a lot of sense, given that XRP had been trading in the marketplace for 8 years. Literally nearly $1 trillion of XRP has traded out there. And so to do that the day before he leaves his position, right a couple days before Christmas, I think was misguided. And as Mary Jo White, the former head of the SEC, has said publicly that she views this as a dead wrong, and the SEC is dead wrong on this decision. I'm hopeful with Gary Gensler, the new chair, likely new chair of the SEC, likely to be confirmed here in a couple of weeks. There's an opportunity to have a conversation with that new leadership as he brings his team in on what can be done that's constructive for Ripple and really for the whole crypto industry to provide that clarity and allow people to participate in these markets and to build companies around these technologies.
Meantime, we're waiting for the Coinbase direct listing, which continues to be postponed. Our sources are telling us that's because of a backup at the SEC. But what are you watching for there in terms of whether or not that is a success or some sort of validation that the crypto market needs?
Well, look, I think it's very clear that the crypto markets at large have become, very mainstream, and there's more and more institutional interest. I mean, my guess is about a year ago, the market overall might have been a few $100 billion, and now it's just below $2 trillion. And that only happens with lots of institutional money entering that market. Coinbase has built an amazing business here in the United States. I suspect that will be a very successful listing, and there continues to be a lot of interest in this space, and there's a lot of different ways to invest in this space. And Coinbase has clearly been a leader, and so I'm excited to see them get out as a public company.
Meantime, I spoke with the CEO of Kraken yesterday, Jesse Powell, smaller crypto exchange, much smaller than Coinbase. But take a listen to what he had to say about price.
I think I said Bitcoin's going to infinity, and that's kind of hard to comprehend because I'm measuring it in terms of dollars, and it might be easier to understand it if we measure it, like in terms of Teslas, right? Like now 1 Bitcoin for 1 Model 3, or, probably by the end of the year, I think it'll be 1 Bitcoin per Lambo, and probably by the end of next year, it'll be 1 Bitcoin per Bugatti. So, I think that to me and to the crypto community, I think those kinds of assets make it easier to measure Bitcoin against because you never know where the dollar is going to be.
1 Bitcoin per Lambo, 1 Bitcoin per Bugatti. Where do you think it's going, Brad?
Look, I think it's very clear that Bitcoin is solving a real problem for people who want exposure to this asset class. And as Jesse, I saw that interview, that was very well done. And I think as Jesse said, there is a lot of inflationary dynamics of some of the major fiat currencies. M2 money supply here in the United States grew about 25% year on year. But I also think we have to remember, and as Bill Gates was quoted recently saying that Bitcoin as a payment mechanism is amongst the least efficient payment mechanisms that man has ever created, because as the price of Bitcoin goes up, the energy consumption and the carbon footprint of a proof of work, that mining that happens to validate transactions, that continues to scale aggressively also. And I think we can't lose sight of the fact that 1 Bitcoin transaction is the equivalent of about 75 gallons of gasoline being burned.
I'm glad you said that, Brad, because Bill Gates said that on this show, said that he was not a fan of Bitcoin specifically because of all the energy it uses. So what's the solution?
Well, to be clear, I am a fan of Bitcoin. I just think we need to be clear about what problem it's solving. And as a store of value, as kind of digital gold, I think Bitcoin is exceptional. Moreover, I think Bitcoin, like the Ethereum network, both Bitcoin and Ethereum use proof of work to validate transactions. But Ethereum, I think, has been some of the developers behind that project have been very forward-looking and realizing that the power consumption is a real problem and have been migrating to a different and much more efficient technology. We at Ripple use the XRP ledger because it's extremely fast and it's about 100,000 times more energy efficient than Bitcoin. So in that context, it works really well for payments. And the reason why we've had so much success gaining customers and continue to scale our business, even in the face of this SEC lawsuit, has been because it works. It solves a real problem, it scales well, and the cost efficiencies are very real.
All right, Brad Garlinghouse, CEO of Ripple. Brad, always good to have you here on the show. Thanks so much for stopping by. We'll be watching how that plays out with the SEC. Okay, coming up, hate crimes rising against Asian Americans, sparking movements across the country. We're taking a look at how tech executives are joining the fight. Next, this is Bloomberg. A shooting at 3 different spas in the Atlanta area this month left 8 dead, another injured. 6 of the dead, workers of Asian descent, sparking a nationwide debate on anti-Asian American sentiment. In a report out by the Center for the Study of Hate and Extremism at Cal State University, anti-Asian hate crimes have risen nearly 150% from 2019 to 2020. The shocking numbers and recent fatal spa shootings sparking a response from President Biden.
Asian American women suffer twice as many incidents of harassment and violence as Asian American men. We're learning again what we've always known. Words have consequences.
Stand with Asian Americans, a new movement which consists of tech executives across the country, is committing $10 million by the end of the year to fight anti-Asian sentiment. Joining me now, one of the leaders of that movement, the founder and managing partner of Hyphen Capital, David Liu. David, thank you so much for joining us. So you wrote a letter, an original letter, trying to rally the community and took out a full page in the Wall Street Journal. What are you trying to achieve?
I mean, I think we're trying to bring awareness to the fact that those who haven't been aware of what's going on in the country and aren't seeing the news, among Asians, we're seeing the news in our news feeds, but everyone else, they might not be aware they weren't aware until Atlanta and the massacre there that this was an issue. And so it's still happening every single day. Even in New York, just this 2 days ago, a Filipino woman kicked multiple times in the head and no one coming to her rescue. It's just constantly happening every single day.
Now, until this point, many Asians that I've spoken to feel they can't speak out on race. Certainly they face racism, they face a unique set of challenges, but many of them don't believe that they have it as hard as Black Americans or the Latinx community, which leads them to feel like they can't complain. Is that a sentiment that you feel, that you hear as well?
Yeah, I mean, we were raised in a culture that we're told to keep our heads down, work hard, not cause trouble, don't draw attention to ourselves. But at the same time, when we've shared our stories, one of the reasons I wrote this letter and put it out there is after talking to so many people, many of us shared our stories of pain, especially the Asian women who've been, harassed, whether it be in the workplace or just on the street. And we didn't feel like we deserved to share our stories. But I think that time is done. Our culture of silence is over. We're a new generation. We're not our immigrant parents' generation. We are starting to stand up. And I think part of this effort of putting this letter out there in the Wall Street Journal and putting it out in the public is so people can realize, hey, I'm not alone. That's okay for me to speak out. And if all these kind of leaders are speaking out, I can too. So I think it's more about motivating those to stand with us and stand up for themselves, because we felt like we weren't allowed to speak before, but I think we're building that momentum and finding our voices now.
Then there is the bamboo ceiling. And if you look at the Silicon Valley community, Asians are very well represented in the tech industry, but they are totally underrepresented in leadership roles. Talk about
That's right.
the unique challenges that Asians face in tech in particular.
Yeah, I mean, at the end of the day, it's very obvious that these tech companies, that 30% or more of these tech companies are made up of Asians. And yet when you index against other races in the exec ranks, but VP and above, they're far below. They're 5x below, anyone else, any other race. And, the whole, we are not aggressive enough, we aren't loud enough. These are things that are not acceptable, and we want to be included in the conversation. I think being in the middle of the barbell of not being able to speak out and not being promoted is that we can't move either way and can't say anything. But now I think we're realizing we want to be part of that diversity conversation, and we want to be recognized and included.
So talk to us about, what else you're doing to get more tech executives on board, and who you're focusing on, and what do you think that will accomplish?
Yeah, I mean, I think first of all, putting this list together, I did not expect this to grow as much as it has. We now have over 1,000 executives and leaders across the country and the world that are supporting us. And I think for the first time, we're seeing kind of this assembly of Asian leaders that most people didn't even realize were the founders and executives of this company. I mean, Asian American founders have built the products that we survived the pandemic on, from Eric Yuan at Zoom to Tony Xu of DoorDash to deliver the food for us, to the Asian founders Yoni and Hisao of Peloton, who kept us working out, and then Steve Chen, who created YouTube. All of these things got us through the pandemic. But these are the products that people don't realize are out there that are created by Asian Americans. And I think the goal is by creating this kind of coalition across all industries. We have partners at law firms, hedge funds, all sorts of industries that we're leaders in. We want to mobilize and motivate all these people to stand up and rise up, and also to give to the causes that they need to give to, because right now, if we don't stand up now, we don't know when we're going to do this.
Do you have a suspicion on the source of the recent hate? I mean, do you blame President Trump calling COVID the China virus? Is it something else? Is it something far more deep-seated?
I think there's a lot of elements at play right now. It did not help that the previous administration, because due to their incompetence in dealing with the virus, had to point blame to China. But it also, because of the language and rhetoric that comes out of leadership, it's emboldened a lot of people to blame someone. They needed a scapegoat, and they chose us. And the fact is, I mean, I was born in Queens. I mean, I've been to China once for 2 weeks, but I'm not from China. I'm as American as the guy who's trying to, as a person next to me, or the people who are attacking the other Asian Americans. So for me, I think it was very much a scapegoat, and people need someone to blame. They've been frustrated for, trapped in there. They want to, get out, and they want someone to point the finger at. And I think that unfortunately turned to us. And right now that just seems to be with China rising and the economy in China rising and us struggling right now, I think it's only going to, hopefully, I mean, it won't get worse, but it may get worse unless we take a stand.
All right. Well, David, thank you for throwing your voice and your weight behind this. Appreciate you, all of the hard work you're doing to raise awareness about what is happening out there. David Liu, former founder and managing partner at Hyphen Capital. All right, still ahead, connected fitness firm Tonal reaping the rewards of booming demand for at-home workouts. We're going to speak to the CEO in an exclusive interview next about a new funding round and how digital fitness looks post-COVID. Next.
For years and years and years, no one believed in us. And now you have Apple saying this is an important enough category that we're investing in streaming digital fitness as well. And then on, you're seeing some of the big players from fitness of yesteryear trying to create connected products and then other newcomers. But it really is, I think, legitimization and saying everyone in the industry is seeing that the future of fitness is at home.
That was Peloton CEO John Foley there with confidence that at-home fitness is here to stay. And just as Peloton has been riding the wave of digital home workouts due to lockdown orders and gyms being closed, Tonal, the creator of a digital weight machine, also saw sales grow 800% last year and just raised $250 million in a new round of funding, bringing its valuation to $1.6 billion. Tonal founder and CEO Ali Ratty joins us now for more in an exclusive interview. So Ali, I'm sure you'll double down on some of what John Foley was saying there, but why is at-home fitness here to stay? Even when gyms reopen, we go back to work, we can get out of the house more often. Will we still be working out the same way?
Well, the trend already started years before COVID hit, and what the lockdowns did was accelerate the move towards in-home fitness. But it's more convenient. You can get a better workout in less time, and that's really what's driving it. Gyms are crowded, and frankly, if you look at the stats, half of gym members used to pay and not even go. Now you have a piece of equipment that you can actually use that gives you real results. In Tonal's case, not just equipment, but the equivalent of a full personal trainer, so that you can work out 3, 4, 5 times a week and actually achieve the results you want, just like being with a personal trainer, just on your terms.
Well, Peloton is, of course, part of the competition, and they're working on other pieces of equipment. John Foley said that in his last interview with us. Then, of course, there's Apple. What do you think will continue to set you apart from the competition?
Well, we're further ahead in terms of strength training from anyone else. What we've invented is a unique digital weight system that took us 3.5 years to develop. We've filed over 40 patents, and that's something that others will not be able to replicate very easily. And when they do, then we do have those patent protections. On top of that, we're the leaders in intelligent fitness as well. What we do on Tonal is highly personalized, highly AI-driven, highly data-driven. And what that's able to do is just give people a better workout in a much shorter period of time. A little different from the group fitness approach that many other vendors in the connected fitness sector have taken.
What additional machines or equipment are you planning in addition to what you have currently?
Well, we're really focused on strength training. We believe that if you hired a personal trainer and asked them, what is the one thing I need to do for the rest of my life, they would tell you strength training. That's what you should do into old age. It's not really a question of equipment at that point. It's a question of the routines that you need and how those should change throughout the course of your life. You certainly shouldn't be doing the same thing when you're 40, 50, 60 years old as you were when you were 20, 30. And so the point is to create an ample array of content that's personalized to everyone's journey, their goals, and where they are in their life. Strength training is something that's proven to have longevity. It delivers results for everything from weight loss to managing diabetes. It's an incredibly powerful tool that's just underused because many people don't have the expertise. The personal training functionality we have, personalization, the intelligence, the AI, really sets us apart from everyone else, and it's the only piece of equipment you need.
Well, and look, I'm sure a lot of people would love to have it, but it's $3,000. How do you bring the cost down?
Well, the financing programs are key. So with financing, a 36-month financing program, it works out to $149 a month. That includes the subscription for the service. It includes the hardware, delivery, installation. And when you compare that, on a household basis to the cost of a personal training session, multiple gym memberships, it really becomes affordable quite quickly. People spend that much money, on coffee. They spend that much money on cable. And if you care about the health and fitness of your family, that's actually a pretty affordable price point with those financing programs. I think the industry is increasingly going to head into that direction of looking at things from a monthly cost and not necessarily an upfront cost.
You've got a long list of investors who are also famous athletes. Talk to us about plans to spend on content in the future.
Well, I think the common thread amongst, all the professional athletes that we have is all of them used the product, fell in love with it, and then wanted to invest. And we're certainly looking at a lot of, a lot of those collaborations. Joining this round, for instance, was Maria Sharapova, as both an investor and advisor to the business, and we're certainly going to be working on collaborations with her in the near term. We also have a few others in the works, and so we really think that can help people achieve goals that are more specific to sport.
All right, the founder and CEO of Tonal, Ali Ratty, thank you so much for joining us. Great to have you on the show. And that does it for this edition of Bloomberg Technology. I'm Emily Chang in San Francisco. We've got Bloomberg Daybreak Australia coming up next. This is Bloomberg.